You know what's wild? Most people treat their money like a video game where they don't know the actual rules. They're making moves, hitting buttons, wondering why they're stuck on level 3. Meanwhile, there's a sequence, a clear order that determines whether you win or lose with your finances. And almost nobody follows it. The frustrating part is watching someone make 90 grand a year and still feel broke. They've got a 401k. They're not using right. They've got a credit card charging them 22% interest while they're trying to invest in stocks. They're maxing the wrong accounts first. It's like watching someone try to fill a bucket that's got a massive hole in the bottom, wondering why the water never stays. Here's what we're actually talking about today. The exact order you should be moving money through your financial life. This isn't advice you hear a lot because it doesn't sound exciting. There's no get-rich-quick energy. But if you follow this sequence, it can change the entire trajectory of your wealth over the next 30 years. I'm going to walk you through every single step so you can stop guessing and start building. The promise is simple. By the end, you'll know exactly where your next dollar should go. You'll understand why that matters. And you'll see why most people are playing the game wrong, without even realizing it. Make sure you stick around, because in a minute, I'm going to show you why most people's biggest financial mistake happens before they ever pick a single stock. Let's start here. Before investing $1 anywhere, you need a small cushion, not a huge one. Just a small one. The reason is almost embarrassing once you understand it. Your car breaks down. Your kid needs new glasses. The refrigerator makes a noise that means you're about to spend $1,200 on a new one. And here's the question: when that happens, what do? If you've got no emergency funds sitting around, you have two options. Option 1, you panic sell your investments at exactly the wrong time, locking in losses. Option 2, you put it on a credit card and pay 22% interest. Both options hurt you. The emergency fund prevents that entire trap. How much do you need? The standard advice is 3 months of expenses. For some people, that's complicated to visualize. A cleaner way to think about it is somewhere between $2,000 and $3,000 as a starting point. Not because it's magic, but because that covers most car repairs, medical copays, and household surprises that would otherwise derail you. The goal here isn't to retire early, it's to not get knocked backward by real life. Once that small cushion exists, something shifts. You can actually think clearly about the next step instead of being in survival mode. Now here's where most people get the order completely backwards. They start throwing money at investment accounts while credit card debt is sitting there charging them 22% per year. Do you understand what that means mathematically? If you pay off a credit card balance at 22%, you just earned a guaranteed 22% return. That's real. That's happening right now. The stock market's historical average is around 10%. You're literally giving up easy money by not tackling that debt first. But it goes deeper than math, it's psychological. Every dollar sitting on credit card debt is a weight. It's a thing you think about. It affects how much you can borrow for a house later. It's a drag on your mind, and that's worth something too. The order here is emergency fund first, then attack any credit card debt or personal loans above 15% interest. That sounds boring compared to opening a brokerage account, but it's the ground floor. You can build the second story until the foundation is solid. Let me put some numbers to this. Say you're paying $500 a month toward a credit card balance at 22%. You've got $5,000 of debt. 5,000 times 0.22 divided by 12 equals roughly $92 per month in interest alone. That's money that evaporates instantly. You're not building anything there, you're just paying a toll. This is where it gets real. Most people skip this step entirely because they want to feel like they're investing debt payoff. Doesn't feel exciting, it feels like work. But work done here has a 22% return. Nothing else will match that. Here's the twist. There's an exception, and this exception changes the game. If your employer offers a 401k match, you should capture that match even before you finish paying off the credit card debt. I know that sounds wrong. Hear me out. If your employer matches dollar for dollar up to 6% of your salary, that's an immediate 100% return on your money. You put in $1, they put in $1. That's better than anything. Let's say you make $60,000 a year. 6% of that is $3,600. If your employer matches that, they're handing you an extra $3,600. In 1 year, that's not interest. That's not a guarantee over time. It's happening right now, locked in. The exception to the exception is this. If you're paying 40% interest on something, that wins. But that's rare. The 22% credit card debt loses to the 100% employer match. You do both, but you prioritize the match. Most people miss this completely. They get a paycheck, feel broke, and don't adjust their 401k contribution. They miss the match entirely. It's like leaving free money on the table and then wondering why you're not getting ahead. This is the part people overlook. Your employer probably contributed nothing last year because you didn't ask for it. That's thousands of dollars that just vanish. Now, once you're capturing the match, the next move is the individual retirement account. This is where tax efficiency starts mattering. A traditional IRA lets you put in $7,000 a year. That's the 2025 limit. And it may change. The magic here is the tax deduction. When you contribute to a traditional IRA, you can deduct it from your income for that year. So if you make $70,000 and put $7,000 into a traditional IRA, you're only paying taxes on $63,000. $7,000 multiplied by 0.24 tax bracket equals roughly $1,680 in taxes. You're not paying that year. That's real money. That's not theoretical. That's happening right now. The Roth version is different. You don't get the tax deduction this year, but every penny you take out 30 years from now is completely tax-free. All the growth, all the gains, no taxes. The choice between traditional and Roth depends on where you are in your career and where you think you'll be later. If you're at the beginning of your career making $40,000, Roth makes sense. Your tax bracket is low now, it probably won't be low later. So pay taxes now, grow tax-free later. If you're in the middle of your career making $100,000, traditional starts making sense. Your tax bracket is high now. It might be lower in retirement, so skip taxes now. Deal with them later when your income is smaller. Most people don't think about this at all. They just pick one or feel overwhelmed and pick nothing. The tax efficiency piece is subtle, but compounded over 30 years, it's substantial. But wait, there's something most people have never even heard of. And this is the part that changes everything. If you have access to a health savings account, this is your secret weapon. I'm serious about this. An HSA gives you 3 tax benefits that stack together, and almost nobody uses them. First, the contribution is tax deductible. You put money in, the IRS doesn't tax it. Second, the growth is tax-free. Your money sits in there, grows, and nobody's taking a cut. Third, and this is the secret part, when you use it for medical expenses, there's no tax at all. Not a tax deduction, not a deferral, no tax, zero. For 2025, the limit on self-only coverage is around $4,300. For families, company it's roughly $8,550. Most people hit the deductible on their medical plan and stop thinking about it. But you can put that money in an HSA and never touch it. Let it sit, let it grow. Here's the math that blows people's minds. Say you max out HSA contributions for 30 years. You put in about $4,300 every year. 4,300 times 30 equals $129,000 total contributions. If that grows at 7%, which is a conservative stock market return, you end up with roughly $400,000 to $450,000 completely tax-free money waiting for you. Medical expenses in retirement are one of the biggest line items in your budget. This account handles it without touching your regular retirement savings. Most people have never heard this explained. They think an HSA is just for this year's medical bills. They're leaving hundreds of thousands of dollars on the table. Now, once you've maxed the IRA and you're capturing the employer match, the next step is going back to your 401k and maxing that out beyond the match. In 2025, the limit is $23,500. That sounds huge, but remember, this is only after you've done everything else. You're already contributing 6% for the match, funding the IRA, and funding the HSA. The reason you prioritize the IRA before expanding the 401k is fees. Most employer plans come with higher fees than independent IRAs. Your IRA gives you total control. You can pick investments with fees below 0.05%. Most 401ks charge closer to 0.5 to 15%. That gap doesn't sound huge, but it compounds over 30 years. Cheaper fees add hundreds of thousands of dollars to your account. 1% fee versus 0.1% fee on $200,000 annually equals roughly $1,800 per year. You're saving just by lower fees. That's why the sequence matters. You're not just saving, you're structuring your savings to avoid unnecessary costs. Most people do this backward. They max the 401k first because it's easy and automatic. They never open an IRA. They never check fees. They're literally paying thousands of dollars extra over their lifetime without realizing it's happening. This is the part nobody notices: the difference between a 0.5% fee and a 0.05% fee. Looks tiny on your statement, but it's not tiny. It's compounding against you. Once you've worked through all these tax-advantaged options, that's finally when you get to taxable investment accounts. These are regular brokerage accounts. No limit, no tax deduction. Just invest whatever's left. It isn't because they're bad, it's because they're less efficient. Every time you sell something, you owe capital gains tax. Every dividend triggers taxes. It's not terrible, but the tax drag adds up. $700,000 to $750,000 because you're paying taxes along the way. The difference isn't small. It's real money, and it's completely avoidable if you do the sequence right. It shifts. You're not just picking between taxable and tax advantage. You're picking between a $950,000 retirement and a $700,000 retirement. The only difference is the order, the sequence, the structure. Now, let me put this entire thing together as a practical checklist, because it matters when you're actually doing this, not just thinking about it. Step 1. Build a small emergency fund of $2,000 to $3,000. This takes most people a few months. That's fine, it's not forever. It's just enough to handle the unexpected without panic selling. Pay down any high-interest debt. We're talking 15% and above. Credit cards, payday loans, personal loans at predatory rates. This is work, not fun. But the return is guaranteed. Employer match. Ask your HR department exactly what the match is. If it's 6%, contribute 6%. Don't guess, don't assume, ask, then set it and forget it. About $580 per month if you're breaking it into pieces, less than $20 a day. The investment you pick inside the IRA is almost secondary to the tax efficiency of the account itself. But explained clearly. You don't need to use the money this year. You can let it sit and grow. It's triple tax advantage. It's the best account the government has ever created, and almost nobody uses it. Your 401k beyond the match $23,500 is the limit. By this point in the sequence, you're already doing this on money that's above and beyond your basic living expenses. You've built the foundation, now you're adding to it. Put anything left over into a taxable brokerage account. No rules here, no limits. Just invest the remainder and accept that you'll pay taxes on gains. That's fine. You've already optimized everything else. They open a brokerage account, get excited about stocks, and completely skip steps 1 through 6. Then they wonder why they're not making progress even though they're investing. They're ignoring the foundation. Skilled investor who ignores it. You could pick the worst mutual fund in America, follow this sequence perfectly, and still come out ahead of someone who ignores the sequence and handpicks individual stocks. This is the kind of thing you don't read about because it doesn't sell seminars. But it's true, offensive. Debt payoff sounds like punishment, but the boring stuff is where the actual wealth gets built. The exciting part, the stock picking part, is less than half the equation, but the boring the twist that makes everything click. Your biggest investment returns don't come from picking the right companies. They come from picking the right accounts and doing the sequence right. The structure beats the selection. You're avoiding taxes that would otherwise eat into your growth. You're capturing free money from your employer. You're using accounts that were literally designed to help you build wealth. You're letting compound growth work on money that the government isn't touching. Let me leave you with 3 clean takeaways. Emergency funds come before investing, employer matches come before debt payoff. Tax-advantaged accounts come before taxable ones. Moving to the next one. Not perfect, just better than yesterday. The sequence is patient. It works whether you're 25 or 45. It compounds whether you're watching or not. Your job is just to start, then stick with it.